constantly told that the economy is a fragile, finely tuned machine. Like a luxury Swiss watch, every tiny gear is supposed to move in perfect harmony, and even the smallest adjustment can trigger massive, unpredictable consequences. History supports that idea. Minor changes to banking rules have triggered global financial crises. Small currency adjustments have erased trillions of dollars in market value overnight. So logically, when an economy faces nonstop shocks, reversals, threats, and policy whiplash, you'd expect something to snap. And yet, it hasn't. Despite aggressive tariffs, sudden reversals, political pressure on central banks, debt repayment restarts, mass government layoffs followed by rehiring, trade conflicts with allies, record deficits, and nonstop uncertainty, the economy is still standing. Growth hasn't collapsed. Unemployment hasn't exploded. Markets are near record highs. If the system really was as delicate as we're told, none of this should be possible. So the real question isn't whether the economy is under stress. It clearly is. The real question is, why hasn't it broken yet? When you zoom out and list everything that's happened in such a short time frame, it honestly sounds like an economic stress test designed to fail. Trade policy has changed direction multiple times in a single year. Tariffs have been announced, paused, canceled, reintroduced, raised, lowered, and selectively applied. Allies have been threatened. Companies have been targeted. Even the basic expectations around consumer debt and government employment have been shaken up repeatedly. In theory, markets hate this kind of instability. Businesses are supposed to pull back. Investors are supposed to panic. Consumers are supposed to stop spending. But instead, GDP kept growing, employment stayed relatively strong, and asset prices didn't collapse. That contradiction is what confuses people. It feels like everything is broken, yet the headline numbers say the system is still working. That tells us something important. Headline numbers can stay strong even while the foundations underneath are weakening. One of the biggest reasons the economy still looks healthy is massive investment in artificial intelligence infrastructure. Trillions of dollars are flowing into data centers, advanced chips, cloud systems, and energy capacity to support AI growth. On paper, this shows up as strong investment and strong GDP growth. It makes the economy look vibrant and productive. But when you look closer, something strange appears. Outside of AI, overall business investment has barely grown, and in some periods it's actually declined. What's happening is that AI spending is so large that it's single-handedly offsetting weakness everywhere else. At the same time, many companies are quietly selling off inventory they stockpiled earlier, which mathematically cancels out some of that investment growth in official statistics. In simple terms, AI is doing all the heavy lifting, while the rest of the economy is jogging in place. If that AI spending slows down even a little, the economic picture would change very quickly. Government spending has also helped keep growth afloat. Despite a lot of political noise around budget cuts and efficiency reforms, total government spending is still rising, especially in areas like defense. That adds to GDP even if it's funded by debt. Trade numbers are where things get really misleading. Imports have fallen, which actually boosts GDP on paper. Exports have risen, which sounds like a big win. But this isn't because American manufacturing suddenly became more competitive. Imports are down largely because businesses stocked up earlier and are now burning through existing inventory. Exports are up largely because the US is selling more precious metals, energy, and military equipment, not because of broad-based economic strength. Selling off valuable assets and stockpiled goods improves cash flow in the short term, but it's not something you can repeat forever. It's the economic equivalent of paying bills by selling furniture, technically effective but not sustainable. Consumer spending is still the largest driver of economic growth, which normally signals confidence. People usually don't spend more unless they feel secure. But this time, spending growth is heavily concentrated among wealthier households. Those households have benefited from rising asset prices, especially in stocks and real estate, so they've continued spending aggressively. Interestingly, this group hasn't become cautious at all. In fact, many high-income households are taking on more debt and stretching themselves financially, which suggests overconfidence rather than stability. From an economic perspective, that still supports growth in the short term because businesses keep producing and hiring to meet that demand. The problem is that this kind of spending doesn't represent broad financial health. It represents momentum, not resilience. A large portion of recent consumer spending growth comes from healthcare and pharmaceuticals. This isn't because people suddenly want more medical services. It's because they need them. An aging population, worsening health trends, expensive prescription drugs, and fear of losing insurance coverage are pushing people to spend more now. Healthcare spending is one of the least flexible parts of the economy. You can delay buying a new phone or car, but you can't delay critical medication. That means rising healthcare spending boosts GDP even when households are under pressure. It looks like economic strength, but it's actually a sign of growing strain. Another hidden factor is the declining value of the US dollar. A weaker currency makes exports cheaper and imports more expensive. That helps trade numbers and boosts corporate profits when measured in dollars. It also makes stock market gains look stronger domestically. But globally, those gains look far less impressive. In many foreign currencies, US markets have barely grown at all. At the same time, Americans are paying more for imported goods, travel, and everyday essentials. Currency weakness can mask problems temporarily, but it often creates inflationary pressure later. So why hasn't the economy collapsed? Because the US economy is massive, deeply interconnected, and still widely trusted. Global systems don't move away from it overnight. Trade relationships, financial agreements, and institutional ties take years to unwind. That size and privilege act like shock absorbers. But that same size also means that if damage becomes permanent, recovery takes longer. Slow erosion doesn't feel dramatic until suddenly it does. What we're seeing now isn't economic collapse. It's economic delay. The takeaway isn't panic. It's perspective. Strong numbers don't always mean strong foundations. Growth driven by asset sales, healthcare necessity, currency shifts, and narrow spending concentration isn't the same as healthy, sustainable expansion. As investors, this is exactly why understanding how growth happens matters more than the growth number itself. The economy isn't invincible, but it's also not fragile in the way headlines suggest. It bends before it breaks. The real risk is assuming that bending means everything is fine.